Today we are going to talk about my favorite investment instrument, that is mutual funds. Hi guys, this is Pragya. I try to make finance simple for you, and today I am going to talk about mutual funds. Those are actually my favorite investment options, and I invest majority of my money in mutual funds. I started investing in mutual funds when I was 21, and they have given me a very good return in the past, and I continue to invest my money in mutual funds while I still trade, because mutual funds are something that give me a sense of assurance that my fund is being professionally managed and the return that I'll get in the long run will always be good. We'll talk about the benefits of mutual fund later, but let's understand what mutual fund is. Like the word says, mutual. What mutual fund does is it takes money from different individuals and it pools the money to invest. Say there is a particular stock which is 1300 rupees. Now you might not be able to have 1300 rupees to invest in that particular share. So see, the principle is when you're buying a number of shares or a bulk of shares, the return that you get on that bulk will always exceed what you get in individual stocks. So for example, when a stock costs you 1300 or sometimes even 10,000, you might be able to buy only one share of it. But when the mutual fund pools the resources, when all your resources are pooled and then invested, you may be able to invest in more units, and so the return that you get will also exceed. Sometimes you might not even have the amount to invest in a particular stock, but when all the resources are put together, a mutual fund might be able to buy that stock and give you the benefit which you would have otherwise missed. So we have learnt about REITs, we have learnt about gold mutual funds. They all work in the similar principle. Money is pooled in and then invested. Whatever return comes is distributed amongst its investors. Now let us understand this through a very simple example. Say A is investing 10,000 rupees in a mutual fund. So mutual fund is divided into individual units. In this case, let us assume that the mutual fund unit cost 10 rupees. So one unit of the mutual fund costs you 10 rupees. So far so good. Now A is investing 10,000 rupees. So he gets 1000 units. B invests 5,000 and gets 500 units. C invests 15,000 rupees and gets 1500 rupees. So the total fund value becomes 30,000 divided into 3,000 units. Now this 30,000 is taken and invested in, say, shares. So over a period of time, say in 1 month, the total profit that the mutual fund is able to generate is 3,000, a 10% return. So the 30,000 now becomes 33,000. The original investment of 30,000 plus the profit of 3,000, that is 33,000. But remember, the units are fixed. So the number of units which are 3,000. So what is the per unit value, which is also called net asset value or NAV? So the value of one unit is now 33,000 divided by 3,000, that is 11 rupees. Remember, one unit costs 10 rupees and now it is 11 rupees. So the unit value has increased, and that is how mutual fund holders make profit, by selling off their units. So I bought a unit at 10 rupees, I am able to sell it at 11 rupees. So that 1 rupee is my profit. Or I'll be able to hold it and that amount gets reinvested again. So as the fund value grows, as profits come and get added to the initial investment, investors make money. So that is the whole concept or the whole principle of mutual funds. You have to also see the expense ratio while you buy a mutual fund. Now, why mutual fund? Firstly, they are professionally managed. See, no matter how much knowledge you might get about the industry, sector, stocks, when a professional gives his 100% towards maintaining a fund, so they research about the market, the trend, the world outside, the economic impact of various sectors on each other, everything. They have a 360-degree view of how things are going to work in the market, and even though they sometimes go wrong, it is still better to let a professional manage your affairs. And that is exactly why I trust mutual funds, because no matter how much I know about a sector or an industry, or how well I can read the financial statements of a company, there will always be some bias involved, something that I might miss. So while I believe in investing in equity, I would also advise that you let a professional take care of your funds. So when you're investing with a limited resource, it is difficult to diversify your portfolio. You can only buy a certain number of shares of a certain company. Since the fund has a substantial amount, the portfolio is diversified and so is your risk. So mutual funds offer you the opportunity to have a diversified portfolio, and at the same time, adding mutual funds to your own portfolio ensures that you have a diversified portfolio as well, and you are not investing all your money in a certain investment instrument. You are diversifying. So diversified portfolio both ways. Now, mutual funds at the same time are liquid, highly liquid in some cases. Sometimes it takes as less as 24 hours to redeem your funds and it hits your bank account. And I have done this in case of 2 or 3 emergencies when I've redeemed my units, and luckily I have got it the next business day itself. So liquidity is something that you can associate with mutual funds. Whereas when you're investing in stocks, the price might not go up or go down the same way that you expected, and so you might hesitate to take out your money. But since mutual fund has a diversified portfolio and the fluctuations in the value of NAV is not too much within 2-3 days, so it's again a liquid instrument. Affordability, that is one of the best parts. You can start as low as 500 rupees and you can invest in a fund that helps you buy a share that is 10,000 rupees. So you see the beauty of mutual funds. You can reap the benefit of a 10,000 rupees stock by investing only 500. So affordability is one of the best parts of the mutual fund, no matter how small you want to invest, and you can start your investment journey really early. You do not have to have a substantial amount before you can start investing in equity. Now, there are variety of fund types available. Before I said equity, so you have the option of investing in equity, you have the options of investing in debt. Now, there are hybrid funds which combine equity and debt. There are funds which specify what ratio goes to equity and what ratio goes to debt. There are gold mutual fund, there are real estate mutual fund, there are exchange traded funds which are earmarked to the exchanges, specific exchanges. Then there are funds which also help you invest abroad. There are funds which help you invest in a particular sector. They're customized funds. So the variety of funds that you get is amazing. It's like shopping in a supermarket maybe. And more importantly, all the mutual funds are regulated by SEBI. They fall under the purview of SEBI, or the Securities and Exchange Board of India. So all these fund houses are regulated and they have very strict compliance procedures that they have to follow, which ensures that the risk is considerably low. So you can invest in mutual funds without really thinking too much about the risk involved. Now, the risk that is involved is in the investment way. Whatever investment happens is subject to market risk. That every mutual fund company will tell you. But before investing in a mutual fund, like investing in any other investment as instrument, please, and I tell you this with every sincerity, please read the fine print of the document before you sign any contract, any agreement. You might think it is boring. You might think that it is, written in very small letters. You might think that, oh, everybody has done this, there is no risk involved. Please read it. It will take hardly 15-20 minutes, but it goes in a long way. Please read the contract or the agreement that you sign. Now, again, convenience. Mutual funds are very convenient to invest. It is like going and opening up an account in the bank. It is actually easier than opening an account in the bank. If you have an account, you could just go to the mutual fund website and start a purchase, link it to your bank account, and it gets debited every month or at periodic intervals, whatever you decide. So it is very convenient to invest in mutual funds. Now, there are tax saving mutual funds also, which will help you plan your taxes, get your ATC deduction. So tax saving mutual funds. Then there are gold mutual funds, which we have already learnt about, which invest in gold or companies that deal with gold and mining. Then there are REITs or real estate investment trusts, which also work like mutual funds, which pool in the money and invest in real estate to get a return, and then the profit is distributed amongst individuals. So all of these funds are there and many more. But mutual funds is something that should be in your portfolio. If you start early and use compounding, then mutual funds can actually give you a very good return over a period of time. So do consider adding this to your portfolio. If I missed something, please let me know in the comment section. If you want to know anything else about mutual funds, also let me know. And we are going to talk about SIP, so please stay tuned. And if you want to start a SIP or a mutual fund, you can also contact me. Thank you. Bye.